Does that fit with the board stuff too? How's that gonna?
With living in Fort Collins?
Well, just and then standing up in practice.
We're live, fellas. It's 10:30 a.m. on the West Coast, 1:30 p.m. on the East Coast. If you'd like to watch this live, you go to Aquarius Podcast on YouTube. Press the button. You get a notification. We do it once a week, same time every week, except maybe next week might be going a little bit earlier because I got a flight to catch. What's up, fellas? We're joined by Mike Mitchell.
Sorry, everybody.
Impact performance coming off the bench.
Yeah.
And Jake Taylor on tour, our man in St. Louis.
On tour.
On the ground.
Yeah, so man on the street.
We are live.
What's up, boys? Mike, good to have you here. I'm excited.
I know, it's been a minute.
Not that I don't love Bill, obviously, but
Bill's great. Yeah, I was flying back from a wedding in Southern California, and it was on a JetBlue flight. He said, "Can you do like after hours?" And I was like, I doubt they want me, but if they do, then the answer is yes. I'm doing nothing today. Today's a good day. Happy to be back.
I got to give a little shout out. We got India, Dublin, Ireland, Montreal, Saudi Arabia, Chapel Hill, North Carolina, Montreal. Did I say that? Crazy. It's awesome.
That's the whole world.
Global. Practically. Australia, you're all locked down. You got nothing else to do. It's 3:30 a.m., but you're probably awake from the night before, so say hello. 3:30 a.m. on a Wednesday morning.
Trading crypto, bro. Got to be awake for the crypto trades.
Oh my God.
Crypto never sleeps.
So exhausting. I have to imagine.
What topics have you guys got for today? You want to riff? I got a few things here. But JT, you got some veggies?
I do. I have a little segment on Wu Wei. So we're going a little Eastern philosophy. I'm going to need your help carrying this one over the finish line, TC.
I love a little bit of Wu Wei.
Yeah. How about you, Mike?
I'm down. Blow it at me. Wait, I'm sorry. You're breaking up. I didn't hear you. So sorry.
Yes.
What was that? All I hear is
Mike got the joke in.
I don't hear you.
You're sir.
So,
I'm going to the gun range after this. So.
I got a couple. I got a good one from Euclidean. John Alberg had this chart in. So Euclidean's a value firm, machine learning, quanti kind of. I think they're based in Seattle. They're West Coast anyway, and he has this relationship between inflation and value. By decade.
Is it consensual?
It's a pretty good fit. Well, I wouldn't be raising it if it didn't work. Yeah, it's consensual. That's okay. Right. Yeah, I don't know. That's a good question. I don't know. Inflation, is that ever consensual? I think you have that kind of thrust upon you.
No, it's monetary. No, never mind.
And then, don't keep going with that one. And then Chuck Royce of Royce Small Cap, they've looked at the relationship between small cap interest rates and inflation, and I'm highlighting it, so it's probably going to be good news. I don't want to give it away yet. But, let's wait a little bit.
So let me see if I can summarize this. A guy running a small cap fund and a guy that likes value are both in agreement that things are looking good for me.
I haven't said. We don't know what the research says yet. I'm going to save that up for a little bit.
Very well.
Mike, you got a topic. You can riff on one of mine. You can have one of mine.
No, I want to riff. I'm here to riff. And the stuff that I'm paying attention to, I'm not really going to talk about because everybody is so tired of it. I'm just not going to discuss it. But I have jobs now, so I can talk about 2 jobs. Actually, I have 3. Count my wife's practice, so we can. Anything you guys want to know about starting a medical practice in Northern Colorado, I'm ready to talk about.
Well, let's
do a huge audience.
Let's do an update on you.
On Mike Mitchell. And then I also joined 2 boards, and one of them I'm on the compensation committee of. So it's been like a fascinating experience. I haven't been to a public company board meeting since Vail in 2010, I think was the last one I went to. So it had been a minute, and that was just as an advisor. So it's kind of interesting going to, and it's Zoom, right? Because of COVID, we're not all in person, but it was interesting. Going to the first.
I'd love to hear some of the your thoughts around that, because I know it's kind of it's an issue. is I think it's totally underappreciated and underrepresented in the investment and business world, the incentives and how they get messed up.
Yeah, the most shocking thing is that, as a brand new board member, I was actually asked to be on the comp committee, because usually the two committees you really want to be on are nominating and comp. I mean, those are the ones that really everybody kind of wants to talk to you and wants to, where your vote really starts to count.
Most popular man in the room if you're on the comp committee.
It turns out for this board, for the Canadian Green First, for the Canadian Lumber Board, the nominating, governance, and comp committees all one. So my friend Kyle, who stepped down from the board to make room for me to go on the board, was on the comp committee, and so there was an opening, and we were like, "Oh, Mike, do you want to join?" I'm like, the answer is 100% yes. It was funny because we were discussing in the board meeting this fees for this transaction they just did, and it's all disclosed as one number, so it's all public what's out there, what the fee was. So we were talking about it, and it's wild when you own. There comes a switch mentally where you own so much of a company, like so much percentage wise of the company, and I think my current stake is like 4 and change %. So whenever they're like, "Oh, the fee for legal was this,"
yeah, you're calculating it.
Banking, I'm like,
it's out of my pocket. Yeah,
and I'm like, that's a 6-figure check from the Mitchell family. I'm like, yeah, I actually really care about that. Sorry for cursing. I'm like, yeah, I actually really, I have some thoughts. So it's really an interesting dynamic. And on the comp stuff, what's so interesting about it for Green First is Green First is a brand new company. It did not exist really a year ago, and there was a chance it was just going to be a single mill operation in Ontario, and now it's 7. So it's actually the 3rd largest lumber producer in Eastern Canada. It's one of the top 10 in Canada. So it's a very real company now. So what that means is we have 1,500 employees, and we've got a real board and a real CEO. And what's so neat and fun about it for me is that the company didn't exist. So we're doing this all from scratch. I mean, there is no board fees. Like my comp as of today is 0, which is a very large shareholder. That is a compensation structure I can totally get behind.
I thought you were taking.
How do you feel about it as a director?
In board feet.
That's right. Taking the lumber
delivery.
So and depending on the day, that's either a very good or a very bad decision. But but realistically, I mean, you have to pay directors only because I've already spent hours I've already spent on this. Since becoming a director, which is a couple of weeks old, I've probably spent 20 hours on this. And you're like, that's fine because I'm a huge shareholder, but you really if you want good, talented, thoughtful people, paying them $0 and then hoping they go buy 5 million shares of stock is not going to happen, right? So you have to pay them something. But I think what struck me, so having sat on as an advisor on 2 boards on Applebee's and Zales going into this, Green First that board meeting was one of the best I've been to. I mean, it really, and I think the dynamic is, I left so energized. I think one of the dynamic is that if you go into an existing board that's been around for 30 years or 40 years or however long, everybody's got their own little agenda, right? And they've got their own little, I'm used to making $125,000 a year, and I'm used to coming to a meeting and having a lunch, and I've got my friends, and it's like it becomes this like little fiefdom, dynamic where you have to sort of cleverly go in and sort of break up these little regimes and try to get new ideas brought in. When Green First, it's never existed. It's like a startup. So you're really starting from scratch. So you can kind of do anything you want. So the chairman of the comp committee sends us, says, "Well, what do you think about this?" And it's like, "Well, I like that." And then I see another company that does it this way. And what do you think about this? And so, and there isn't really a set agenda that anybody has. I mean, everybody's just sort of, but the words that I like to hear. So, and it's always, and I heard it a lot, which made me very happy, is, well, what's the most shareholder friendly thing to do? What's the way to create the best alignment? So I'm just like, I'm aligned. I want you to be aligned. And I think we'll get there. I feel good about it. So that's what's going on with me. It's actually a lot of work, but when I got asked to do it, I was like, holy shit. Yes, of course I'll do it. I'd love to. It's been fun, and hopefully it'll keep being fun.
Would you look at what Berkshire does as a model for some of those things? Do you have DNO?
Yeah, so we do. We do, and we will have DNO. I would say it this way: if we didn't, I wouldn't join, candidly, because So number one, Berkshire is an insurance company. So, they have the ability to self-insure. It's just for me, like, there's so many things that happen. I mean, we were on a board, and there's another microcap company I'm thinking of that's kind of well known on Twitter that won't mention the name, but has had some restatement issues. And, there's just so much shit that can happen that you do everything right and you try really, really hard. And then somebody just does something bad. And Warren talks about that. He says, somewhere in Berkshire, there's too many people. Somebody's doing something wrong. Well, if you're Berkshire and you have essentially unlimited funding, I'm not 100% sure it makes sense to go out and get D&O. But for me and my family, like, I definitely want D&O, because if somebody does something really crazy and as hard as we work, we don't catch it, like, that liability, it's just not worth it to my family to take it. So my personal view, other people could disagree with me. If somebody wants to go on a board and not have D&O insurance, God bless you. But that's not me.
Buffett's passed before on a business or several businesses that because of the potential liability of them, even though it was a reasonable business. So one was like a security thing. And he actually said, like, whoever owns this business should have a net worth in like the 2 figures, because there's just too much downside liability for you.
That's it. And you have to think, honestly, you kind of have to think that way of like, listen, I'm really excited and I'd love to do it, but it'd be a great education and I'd love to help shape the future. But if my family's going to lose 100% of everything, not just 100% of the investment, which would be bad enough, if it didn't work out. But losing my house doesn't seem like a pretty good outcome for me. So I'd take a strong pass. The Buffett's, the Berkshire stuff, I think we all, myself included, hold it up as the model for how people should be incentivized, how boards should think about it. The number one thing for me is I agree wholeheartedly with the sentiment that nobody should be on a board if they need the board fee to live. Meaning, when I approach compensation
and call it independent.
Correct. Yeah, correct. If I'm unhappy with the way that my board seats are, if I'm unhappy with the direction of the board, it's not a problem. I have a full-time job. It's just, thank you very much. I enjoy you guys. I'll still be a shareholder, but I'll do it from the outside. I have the ability to walk away from it. I don't think anybody should be a board member if they don't have the ability to walk away from it, because you become, exactly to your words, you're technically independent, but you're not. You're not focused on shareholders. You're focused on keeping your job. Luckily, we don't have that issue with either of the 2 boards that I'm on. So my thought is, as little cash as possible, as much stock as possible. And I think that creates more of an alignment. I think, if people need cash, then, getting a job as opposed to being on a board makes a lot more sense. And I'm fortunate that I just, got a spouse that supports me, and I'm basically a bum, so I don't need the cash. But I think that's Berkshire saying, Warren saying I take very little salary, and the board members getting paid very little and not having D&O. I think that's like the benchmark ideal scenario. It's not realistic for 99.99999% of companies, but yes, if Warren called and said, would you be on the Berkshire Hathaway board for no D&O and $5,000 a copy a year, the answer is 100% I would do that to be on the Berkshire board. That's a one of one. There's not another example of that. So there's a reason why McDonald's pays, whatever, $300,000 a year per board member. I just made that number up. It could be 200. I know it's not 100, but there's a reason why they all pay and have D&O. So they want to get good people, and Berkshire's a one-on-one. So it's not a perfect example for everybody. It's the standard. I would love it but unfortunately, Berkshire hasn't called me yet. So
you also have the issue that you might be completely in the right and you might ultimately prevail, but it's extremely expensive to defend yourself. And that's really what D&O is for. It's what you're trying to figure out where the wrongdoing lies, and you can defend yourself with that. That's what it's being paid for. And then, if it turns out that you were grossly negligent or whatever the standard is, I don't know.
Yeah,
and
that's right.
Then you're probably appropriately gone. But it's that period in between where you got to pay the lawyers and figure it out. That's really what it's for.
Yeah, that's very well said. I mean, it is I wonder, do you guys know of any other public company that intentionally does not have D&O, including companies that Buffett's invested in other than
Tesla?
Berkshire Hathaway?
Just a few little chop shops.
And I'm saying that I'm saying that they don't have D&O because they can get D&O but choose not to. I'm not saying that they can't.
Okay. That might not be
uninsurable. That's not.
It's self-insured.
Yeah, I think the idea is that you have to pay these people something, and I'm totally on board with that because I want good people watching after my investment. But I do think that the key for me is just making sure they're aligned. Like, you just don't want a scenario where they're going to do well regardless, of what happens. You want them. I have the Malone philosophy of compensation. It's probably more relevant to me than the Berkshire theory of compensation.
What's the Malone theory?
So John's idea is that you set these really high standards for stock prices and for results. But when they hit them, if they hit them, you pay the shit out of them. You just dump cash on them. So probably recent example, Charter, Tom Rutledge's options package. I remember the stock was like 200. And I think I'm going to be roughly right. I may not be exactly right on this, but John's comp package, and this was through Greg Mafabian on the comp committee for Tom Rutledge, was like a 5 different level strike options plan over like 10 years. If the stock got above 580, 590, something like that, the guy was stand to make like $500 million. And it was going to be insane. But, Greg's point to him was, look, if you can take the stock up 2x, like 3x, I deserve to pay you. And he did.
Pay the man his money.
Everybody got rich. Yeah, everybody got rich. Tom more so. So that's John is okay with his guys doing better than everybody else. I would also say, like, we don't know what a lot of the executives in Berkshire Hathaway make. It's just not disclosed.
Some of them.
I bet you some of those guys are making, 9 figures. That wouldn't surprise me. So it's like, but, I bet you if Warren were here, he'd say that's true and they're totally worth it. I should pay him more. That's my view too, is that you just set these targets. Like for each of the businesses, they have a plan, something they want to accomplish. It's a multi-year plan. My view is if they can do it, we'll all make a lot of money. So I don't mind paying them really well if they do it. If they don't do it, then that's a different story. But if they do it, I'm happy to pay them a lot of money. I mean, that's in my mind, that's a good outcome for everybody.
Let's segue a little bit. Mate, lumber year on year, is that up? Forgetting a little squirt in between.
I did not use that word. I want to be very clear. I did not use that word. I didn't use it in the pregame talk we had. I didn't use it here. I'm happy to go into it, but I did not bring it up.
I'm bringing it up because it goes into my. I just want to. I think it's sort of more of a conversation about inflation. Like, what's everybody's feeling on inflation? Are we seeing it as a transitory? I'm interested because the more articles that I see now, John Authers at Bloomberg has been on it pretty consistently. I think everybody who's in a position that doesn't want to see inflation doesn't see it, and everybody who wants to see it sees it. So I'm sort of a little bit confused. I'm objectively trying to figure it out. Just interested to know what everybody else thinks.
Can I climb on my soapbox a little bit for this one?
Please do.
Okay. Well, this is against my better judgment, but I was just listening on my walk this morning, listening to the Berkshire meeting as I do religiously now these days. And it's 2015. Someone asked about inflation, and Munger said, like they asked about the businesses, like which ones would be affected and which ones wouldn't. And Buffett talks about the companies that do not require new capital at higher and higher prices tend to do better than ones that require continuous reinvestment in which to generate income. And of course, that makes perfect sense. And then Munger said when it gets really high, it starts to become very difficult to figure out who is going to get impacted more than others. And then he said that he says, like, one thing that people forget is that really high inflation in Weimar Republic plus a Great Depression led to Hitler. And he said, and we paid a terrible price for that, obviously, like World War II. And I'm kind of fundamentally bothered by the idea that, and especially as a father of 2 young boys who may or may not have to pay some eventual price for this, our monetary policies, in my view, are largely taking short-term gain and for longer-term pain and kicking the can down the road and kind of hoping it will be someone else's problem. And frankly, I find them to be a little bit spineless, if I'm being honest. And the fact that throws more ping pong balls into the hopper, in my opinion, of some potential runaway maybe inflation, or I mean, we're certainly like playing with fire, I think, in some ways. And if that then is what would create the dynamics that would lead to a world war, type of situation, like, God, just because we couldn't just like take a little bit of our medicine today and it was politically expedient to just keep kicking down the can down the road, like, shame on you for that. Like, be a leader and step up and take some responsibility for where we are. And anyway, I'm going to end my rant there, but that's been, it was bothering me this morning after listening to that.
That's something I disagree with. You were talking about politicians and then you used the word responsibility, and I'm just not sure. You lost me. I was totally.
Yeah.
Was it breaking up?
Yeah, you're breaking up.
Sorry, you're breaking up.
Zoom is very inconsistent.
It's funny. I mean, Tobias probably has a better take on this than I do. I don't disagree with anything that you said, and I certainly don't disagree with Charlie's take on it. For me, I have trouble figuring out how much of an increase in assets, so in goods, how much of the price increase was due to fiscal stimulus, so checks, money hitting everybody's bank account, and then also, savings accounts and savings rates increasing because people didn't have to pay rent and forbearance and these kinds of things. So how much impact that had versus how much impact when you gave those people money and they didn't go back to work. And so it creates these supply chain issues that we're now feeling like. So how much of it is supply driven and how much of it is demand driven? And I'm having a lot of trouble sort of parsing that out. And I think it's twofold. One, because I'm not an expert, and two, because I'm just generally not a smart person. So I can't really figure out exactly what is what.
It's unknowable though, really.
Yeah, well, I think this will be knowable in hindsight, right? So we're 12 months from now, 24 months from now, it's going to be a really interesting conversation to look back and say, well, if the supply stuff starts to look better, if it's a supply-driven problem, then that should lead to lower prices. And so you're starting to see this interesting narrative shift. I'm seeing it on Twitter. Twitter's amazing for narrative changes. I mean, you can almost like feel it when it happens, and so there's a narrative shift happening about this, discussing deflation as the main story in 2022. If it's a supply driven issue, then that would make some sense to me. When supply chains start to ease, more supply comes online. The question is too, for me, and I pay a lot of attention to housing, if you think that supply chain problems are the main impediment for driving home prices higher, I think it's a combo of demand and supply. So when you relieve the supply, I think it might put a cap on pricing. But if I'm right about demand, then I think, it may be inflationary anyway. So I have trouble parsing that out. I think we'll know the answer soon enough. I sure hope it is more supply than demand driven. Like, my hope is that supply, when it comes back online, can really increase to meet that demand. If not, I think we may be in a little bit of a pinch, because the one thing I see that really just gives me heartburn is interest rates. And that's the one. Interest rates being low is supporting a lot of what's going on. And if interest rates really have a material increase, and I couldn't tell you if that's going to happen or not, but
they've been running up a little bit, I've noticed.
Yeah,
because I watched the 10-year pretty closely. It's
where is it, like 1.6 now? 6 and change?
Yeah, a little bit over. Yeah, but that's right. That's about where it is. And I've seen some, like, I forget which big bank it was, but I watched the Bloomberg clips on YouTube late at night, and a few of them were a few weeks ago. Guy said, like, structurally, we think it should be at 1.5. We think it should be 2 by the end of the year. I don't know, what their track record is or how likely or what they're basing any of that on. And I have heard before that 2 is like a magic number. We're above that. But then it's sort of the Fed has control of it. It's a slight. My question is, when they say deflation, what are they talking about? Like, they're talking about the stock market falling over, right? Or house prices falling over. Are they talking about like a slight decrease in the price of goods? Because wouldn't that be a good thing? Doesn't that happen with the TV and computers and cars and all that sort of stuff? Like, your car gets better. Yeah, well, a little bit. Like the inflation, when everybody talks about inflation, what they mean is, when I go to the supermarket and I go to buy stuff, it's more expensive than it was last time, or it's smaller than it was last time. It's got a little dimple in it now, where it used to be X and now it's 0.9 times X. Yeah, because there's a little dimple in the bottom where they're hiding how much they're actually giving you. And then there's this argument that comes in, what we really should be worried about is deflation. And then what they're talking about there is like the stock market going down. They're two different things. And it frustrates me a little bit that the conversation is like that. I think the thing that drives inflation, higher consumer prices, however it runs, is the Fed just printing way too much money. And they've just been going absolutely gangbusters globally, every central bank racing to see how much they can pump out there before everybody wakes up. Because when everybody wakes up, then it's 1970s style stagflation. Hyperinflation, I think, is more of a political phenomenon where there's something else going on. Weimar Germany is probably a stretch, I hope. I think the real issue is going to be a 70s style stagflation. And then you pair that with like an energy crunch because the world has transitioned too quickly to renewables. And, we haven't spent enough time reinvesting in energy. That's the thing that worries me. But as a value guy, it might be okay for me. But for humanity, it might
everyone else.
Did we just all hold hands and decide to buy crypto? Is that what just happened on this value up hours?
The crypto guys make a very compelling argument, I got to say.
We'll sort of play it out.
And they've seemed to be pretty right so far.
Yeah, I mean, that narrative just continues to push higher, doesn't it? I saw Bitcoin broke 60,000. So it's like everybody's talking about trades working, not working. That one just seems to keep plugging away. Yeah, I don't know the answer to that question. I if I knew the answer to that question, I'd be a lot wealthier than I am today. I don't know. I think what I'm seeing people discuss is deflation in commodities. So energy deflation.
That's a good thing, surely.
Yeah, no, I don't necessarily think it's bad. I think
unless you're long lumber.
Yeah, well, lumber actually has some very unique dynamics to it. It is a global commodity, but it's also expensive to move around. So it ends up being, for the most
localized,
part, a reasonably local market. Yeah. So it really is about the supply and demand dynamics in North America. It has a similar, there's a similar question. Is it going to be driven by supply? Is the price going to be driven by supply, or is the price going to be driven by demand? And that has two very different outcomes. So you as somebody who's long the commodity, I would much rather the price be driven by demand than by supply. I think either way I'll be okay, but the really good outcome is if it's a demand-driven pricing dynamic, not a supply-driven pricing dynamic. So,
why do you think it took? So there's been this underinvestment in housing, but why has everybody just woken up now? Like, why does that? What is the catalyst for that? And why wasn't it sort of more of a gradual thing? Like, why are house prices up 20% year over year?
Well, there's two theories. There's a bull case structural demand theory, which is mine. And then there's a pull forward one-time bump demand theory, which is what Zellman who's very good, by the way. They're the best I can figure the one bear on housing. And they're basically making the point that trends had been moving a very specific way for 10 years. And that when COVID happened, the trend changed. And their point is it's a one-time change driven by COVID, and we're going right back to the prior trend. My view is that if you look for every generation going back for 40 years, there is a decelerating trend in household formation. There is a decelerating trend in fertility. My son has some very strong views about fertility and household.
That sounded bearish to me. I don't know.
Disagrees.
He takes the other side of everything I do, and so far he's looking pretty smart. See how that pans out for him. But yeah, so there's this question is, well, the last 10 years since the financial crisis, the housing crisis, those rates have been like dramatic. And then the one thing that had been kind of saving us was immigration, but with Trump in 2016, immigration just went, and then with COVID, immigration's just been in the crapper. So our population growth as a country has not been all that strong. So the bear case is that we had this one-time pop from people exiting cities and a lot of people buying second homes, because now with COVID, it's like, well, I want a guaranteed spot for me to vacation. I don't know what the availability is, so I'm just going to go buy it. So there's a lot of second home buying and then a lot of exits from cities. That happens one time, and then the world normalizes and we get right back on that trend. So what Zellman's point is like builders are going to go chase it. They're going to overbuild over the next 2 or 3 years. And then we're going to find ourselves back into a housing glut situation, which we haven't had. It's a spicy take because if you go back even anything more than 10 years, anything more than the last decade, you see a completely opposing picture. So which is where my head is, and then I sprinkle in some other little fun things around it to make it seem like it really could be quite phenomenal. But
isn't it? It's very interesting because we had this. Didn't we talk about this last week, Toby? Where if you parse out the data of investing returns as well, it was like you had like pre 2010 to 2020 looked so different than what 2010 to 2020. And like which lesson do you want to learn, like as far as what works, right? Like there's so much, like the world got weird in 2010 forward.
Yeah, I think that's right.
Got pretty weird in 08 and 09 too. That was not a fun time. But yeah, so that the bull case for housing demand. So the other side of that is that you have a demographic shift where if you look at population by age cohort, the bulk of our population right now is 25 to 34. The average millennial is hitting 30 years of age. So if you think in every generation prior, what happens when you turn 30? You get married, you have a kid, you buy a house.
Freak out.
Yeah. you get a minivan, like that sweet minivan that I've got right
Cadillac
outside.
And minivans right.
It is the Cadillac, but it's every bell and whistle you could possibly get. So what happens is that people, get married and they get a house and have kids. So that normally what I would have expected to see for at least the next 4 years is this migration to single family causing increased demand. And all the while we haven't really been building, which nobody disputes, we haven't been building. That's just a number. So that you're going to have a lot of people show up to buy houses, and people are staying in place longer. So as people age, they're not going to senior centers as much anymore. So there's not nearly as much inventory for these people to sort of absorb. And then sprinkle on top of that, this work from home dynamic. It's really fascinating to me. And I have a very strong view. We're going to see if I'm right or not. But my view is that once you give, Munger always told the story that he's like, I discovered this psychological tendency with my dog. I had the sweetest dog in the world. The dog was great, gentle, no problems. But if you gave that dog a bone or a piece of meat, and then you tried to take it back, the dog turned vicious really, really fast. My view is with work from home, once you give it to people, and now that it's sort of ingrained in everybody because we've been doing it for 18 months, it is really hard to take it back. And the points of the evidence I have that it might never come back, at least to where it used to be, is you've seen some really old states, like old school companies, Allstate, PwC, announcing that they're like letting tens of thousands of employees have a permanent work from home or hybrid structure. Amazon just said they're going to do that. I believe Apple's doing it, Facebook, but it's happening to non-tech businesses, happening in insurance, it's happening in auditors. So I'm looking at that, I'm thinking, well, so what does it mean if I can work from home even 3 days a week? Well, I don't have to live in San Francisco anymore. I can live, I think you could even live in like Davis, or you could live in Sacramento, work 3 days a week in the office or 2 days a week in the office. It's a heck of a commute, but if you only had to go 2 times a week, why don't you pay half for real estate? So if that dynamic persists, what I think will happen is it won't necessarily create a new household, but it will create the need for a new housing as people decide to sprawl, right? It just gets cheaper cost of living, better schools, lower taxes, lots of reasons for people to move. I think you're going to create structurally demand for new housing units over the next few years as people decide they could just live anywhere. So I remember,
it sounds like a lot of demand for energy then to facilitate that kind of sprawling.
Yeah, self-driving cars, work from home, flying cars.
Mike,
well, it sounds great.
What do you think about this statement? What if the demand for all that housing is sitting in Harvard's endowment right now? Like student loan, basically, like crushing.
I thought you were going to go in a different direction, and I was going to actually even push on that a little bit farther. But let's go down the student lending path. There is a scenario where even though balance sheets look pretty good, that 25-year-olds to 30-year-olds decide, look, I can't afford to buy a house because I've got to repay my student loans. That's part of the Zellman case of like, I'm not sure. For 10 years, people didn't get aggressive when they're 20s buying homes, right? And my thinking is that now that they're hitting their 30s, I tried to raise a kid in an apartment in New York City. It was really unpleasant. I was very happy when we had our second child to move out. My theory is everybody else is going to think the same way. So, I'm projecting. So we'll see if that ends up being true or not. It could be totally wrong. Zellman's point is that they'll go right back into that, like, I've got too much debt. I'm just going to rent and I'm going to stay in multifamily. And so they're not going to need a new single family housing unit. And that could be right. That absolutely could be the case where people just feel like they're too levered. My thinking is, so it's an interesting dynamic, is that the millennials saw the housing crisis, and it was the first time at least in my life, and I think in the history that I studied, where housing really took a digger. Like, it was believed up to that point that if you bought a house, it was almost impossible to lose money.
It was not true though, right? It wasn't true.
No,
like that was.
It wasn't true. It was just the belief.
That was the belief. Yeah.
It's just like everybody believes in stocks. It's impossible to lose money, and of course we know that's not true. But it
hasn't been true for a long time.
You're breaking
up. Sorry, you're breaking up. I can't hear. What was that?
What about the? There's a good comment here from Mike Bartlett in the comments. Fed purchased a total 580 billion in mortgage-backed securities during March, April 2020. And has since averaged 114 billion per month. That's got to have some impact, right?
Sure, it keeps rates really low, right? I mean, that's the idea. I mean, that's why you can go get a 15-year mortgage right now for 2.15. I can get a 30-year for 3.2. I mean, that's happening because the government's letting it happen. It's not happening because the banks really want to lend money that cheaply. That's why I say the risk in my mind is interest rates spike and it becomes less affordable. It's actually very affordable to buy a home now. Have studies off the top of my head, but if you go look at any inflation adjusted mortgage payment, because interest rates are so low, even with prices so high, it's actually very affordable to buy a house. I think it's more affordable to buy a house than it is to rent. And that's part of it.
I think the deposit's the issue, right? The deposit's the issue because the deposit goes up with the house price.
Yeah, that's right. There was a funny, somebody tweeted something funny. It's been, I've been saving up for a 20% down payment for 10 years. And meanwhile, the price
never caught up.
Tripled.
Yeah.
But I also think that creates a dynamic too, where, as the price goes up, if it happens really quickly for anything, a house, a commodity, people get a shock, right? And they're like, whoa. And then if it comes down at all, it's like, okay, now it's like reasonable, even if it's more expensive than it ever was. And the one I'm thinking of a very specific commodity right now that I pay a lot of attention to.
They all look that way. It's not unique to one.
And now everybody's like, oh, it's cheap. And I'm like, yeah, it's the current price is 10% above the prior peak before COVID. And that used to be considered like, holy hell, why would anybody ever pay that price? And now everybody's like, yeah, that price makes sense. And I'm like, that's what I want to hear.
Total recency bias.
But it's also, I think, extends to housing for millennials. Is like, you see, the people who bought homes. I bought my home in Colorado in 2018. And I remember thinking like, I'm probably overpaying for it. I think I did overpay, but the house hadn't traded in 50 years. It was a one of one. My wife and I were like, you know what, this is our forever home. We'll just do it. And now that's looking like we got the steal of the century. And my sense is that if I'm right about demand and we just can't structurally build the homes fast enough, the people who are buying homes are going to look pretty smart 2 or 3 years from now too. So, I think that perception, I do think in the United States, people want to own homes. It's a fundamental belief of mine. And I think it's been different for 10 years because millennials watched the housing crisis. But I also think I think it's just a fundamental thing to us. I think we all kind of want to own. It's interesting if you talk to immigrants that come from places where people mostly don't own their homes. Everybody's like, this is like a cool feature of the United States where it's just expected that you will. So my guess is I fade the Zellman thing, but I would say, and I would, if I didn't say this strongly enough before, she's really good and I'm kind of a dope. So we'll see if my fade of the Zellman report ends up being right or wrong. But that's
one of the interesting things about the work from home phenomenon, which we've talked about before. And JT had this chart that he tweeted out earlier today, which basically there's many fewer people working from home, even at the peak of the pandemic, whenever the peak was, March 2020, or whenever most people were working from home, that there were, I think the absolute peak was like 40% or something like that. And then currently it's about 12 or 13%. Those numbers might be right. That's just off the top, might be wrong. That's off the top of my head. But JT had this percent teleworking because of the pandemic by occupation and month. And really it was mostly the biggest area is secondary school teachers, elementary and middle school teachers, post-secondary teachers. This is by order of working from home at the peak of the pandemic.
Percentage who are working from home.
Of the profession, yes, yeah. Proportion of the profession. And then software developers, lawyers, education administrators, teaching assistants. So it sounded to me like it was mostly, there was a lot of teaching in there, but a lot of most of the rest of the folks were in the office. What's the impact on, if it does in fact turn out this way, what's the impact on real estate prices, commercial real estate?
Well, again, this is a guess. And I have a guess, but it's just a guess. Somebody said this the other day, and it's exactly right. It's a better, smarter way of saying something that I've been thinking and saying for a while, which is 2019 is not the right baseline. 2020 is also not the right baseline for what the next 10 years are going to look like. I have no idea what the right baseline is, but I know it's neither one of those two. So we are, it's like I was saying with the board engagement and creating a comp plan, like we're starting from scratch a little bit here. Like we're all kind of making guesses about what we think, but the world in my mind is definitely going to be different. It's just a question of to what degree, what's going to be different, and to what degree is it going to be different. And so it's a little bit of a guess. I wonder on that study, is it what I'm more referencing in the housing stuff is a hybrid work from home. So if that's just a pure telework, then yeah, I agree. Pure telework, I struggle with, because even for me, I'm like, I'm happy to do these meetings, board calls and things virtually, but like there's a board meeting, it's actually an annual meeting coming up on December 6th. If you're in the North Carolina area, come to Charlotte, 5 p.m. on December 6th. We're gonna have I think it's 5.
Is it the shareholder meeting or the board meeting?
Yeah, shareholder meeting. I think we're going to do it in a fun venue. I will be there in person.
Chuck E. Cheese.
Can you imagine? As a fun venue is Chick-fil-A, just so everybody knows all the nuggets you can eat on me. So anyway, so
like 5% of them are on you.
Yeah, 5%. That's right. Exactly. So but some of this stuff I think will need to be done in person. But the hybrid work environment, particularly for white collar employees, creates the ability. It increases the radius at which you can live from center, because it allows you to commute farther. But since you're doing it less, it actually seems to be reasonable. So my guess is that's probably that type of hybrid environment is probably the new normal, where you're not expected to be in the office from 8 a.m. until 6 p.m. Monday through Friday.
It makes so much more sense from a business perspective too, right? Because like rent's expensive. Getting everybody into the office is expensive. There's an enormous amount of wasted time commuting, getting ready in the morning and commuting. Yeah. And I think that people discovered that last year when they were working from home. Like all of a sudden there's no commute. You just sit down at the computer. And so you're getting another hour or two of work in every day. That's not necessarily a good thing. I think people probably burned out from working so hard over the last 18 months. But that's a pretty compelling argument from the business perspective too. Like, maybe you buy a computer for their home. Maybe most people have already got a computer at home. Like, cuts your costs down.
Well, one area that I think, so on commercial office space, I kind of go back and forth. I think if you own like class A++++ in San Francisco or New York, I just have to think there's always going to be, I would wonder about what the rent inflation looks like over the next 10 or 20 years, but I guess it's all going to be leased. I would also guess that those like the Serendipities or the WeWorks, I don't know what they have everywhere here. They're all Serendipity labs. Those little communal spaces, my guess is those are going to be fine. I would think that those actually kind of get full, because you're working from home for $100 a month. I can go get a desk at a Serendipity lab and actually like just go somewhere to get away from kids and noise and just have a space. And that's not really an unreasonable amount of money to spend to have a place to go. So my guess is those are fine. The one area that I think, if I had to guess of like what's really going to take it on the chin, my guess is T&E budgets for people who used to travel an awful lot for work. Like, I'd be really worried about the business class fare sales, like that stuff where, an American Express T&E budget, their T&E spend, I would be really surprised if that came back and was as strong. I would guess structurally that over the next 5 to 10 years, you're just going to see that number be lower, because so if I don't have to be in the office more than 3 days a week, I can do a lot of sales calls initially over Zoom. It's just normal that, I'm going to do a sales call over Zoom. I think there was an anecdote I heard too, and I forget, there was a sell side lunch that, and they were trying to organize everybody to come into the city. And it was like, they got all this blowback. They were like, just do it on Zoom, dude. Like, I'm in Connecticut. Like, I don't want to come in just for a lunch. 5 years ago, there's no scenario that would have been done on Zoom. Now it gets done on Zoom. You get the option. You can be there in person or you can do it online. I think that just takes a permanent hit out of T&E spend. Just a guess.
JT, you want to do your veggies before we're sort of 1/4 the hour? Oh
yeah, let's do it. So yeah, let's get deep in some Eastern philosophy to close out the hour. This concept of Wu Wei, which if you want to look it up, it's spelled W-U and then W-E-I. And I'm going to start out by reading a little passage from the Tao of Pooh, which is like this book about Winnie the Pooh, but it explains Eastern philosophy, because that's where I have to start. Paint by numbers. But so here's what it says. When we learn to work with our own inner nature, and with the natural laws operating around us, we reach the level of Wu Wei. Then we work with the natural order of things and operate on the principle of minimal effort. Since the natural world follows that principle, it does not make mistakes. Mistakes are made or imagined by man, the creature with the overloaded brain who separates himself with the supporting network of natural laws by interfering and trying too hard. So first of all, that's like a really nice little passage, but like just it's very hard to explain Wu Wei. And because you can take so many different angles on it, but I'm going to read some of them and see if any of these resonate. One definition might be the alignment with the rhythms of the elements, effortless surrender to natural cycles of the world, ultimate energy of the universe, the drift of nature. Others kind of put it more as like non-action, which kind of sounds like laziness, right? If you on one level, but I think it's more that like you work hard when you're in the flow, but you don't fight it if you're not. There's this Lao Tzu quote that says, "Nature never hurries, yet everything is accomplished." And there's also, I think, some elements of authenticity to it. Like you don't try so hard not to be yourself. So like that's sort of like to me is represented. Like I watched The Big Lebowski again recently, and like just the idea like the dude abides. Like I love that. It's I find it to be it's so pithy and good. But really like this is kind of why I often look to nature for some of the bigger truths, because there is an energy to it. There's cycles to it. And I think there's a lot that we can learn and try to like sync ourselves up with that. Anything that you guys that you want to add at this point before I go into what I think maybe some of the implications are of this?
The way that I have understood it is just that there is an objective reality and there is a way that things are going to unfold. And the better you are able to understand it and to align yourself with the way that things are going to unfold, the easier everything is. And I think that the way that the analogy that I like is just if you're at the beach and there's a tide and you can float in the water and go with the tide and you go a long way down the beach and you can swim against that tide and stay where you are and put out a huge amount of effort. And that provided the tide's going in the direction that you want to go, it might be easier just to sit in the tide. If you swim with it, you go even faster. But the idea is that you figure out what has happened, what is likely to happen, and you just sort of go with it.
Yeah. So I think from a business standpoint, I think finding the businesses that are operating with a win-win mentality with all of their counterparties are going with the tide of recognizing this universal principle of reciprocity, and that is like one of the ways in which to be in Wu Wei. I think like capital cycle theory kind of makes sense to me from a Wu Wei standpoint of there are natural ebbs and flows as capitalism moves from glut to not enough, and it works its way around and through equilibrium, and just understanding that that's going to happen and not drawing straight lines and projecting them off will give you quite a bit of an advantage. Even like just like trend following to me sounds like it's sort of Wu Wei. I mean, I know it's a lot of value guys will turn their nose up to that kind of thing, and I personally do not engage in trend following. However, that doesn't mean that, like there's not a lot of people who think it works, and it probably does.
Momentum, right? Momentum is a pretty well documented quantitative phenomenon that seems to be more robust than value. And I saw Corey Hofstein was here as well. Yeah. Corey might be able to shed some more light on it, but I forget who said this, but it was a pretty great point that they made that, if you're in a market where tech is trending and that's going to go on for a decade and you're in momentum riding the tech, and then the market breaks down and it turns into a lumber, oil and gas, those become momentum. This is what's happened over the last 12 months as value has slowly, gradually started to become momentum. The momentum guys haven't had to make any great switch to their strategy. Now they're already in the thing that started working again, and they're going to be okay.
Yeah.
Structural tailwinds. That's what you're looking for, structural tailwinds.
Yeah. So I think think about like how Munger runs Daily Journal's portfolio and just how opportunistic he is. Like he is not forcing it, right? Like he just waits until there's something very obvious to do, and otherwise he's he's not swimming against any tide there. He's
That's
in
the
no
difficulty,
rush.
right? Is separating out the things that are very obvious from the things that aren't, because that's everybody sees those very obvious trades once every 5 years or so. You just see something that you're like, well, it's everything that I understand and it's way too cheap and I know how this is going to work out. But there's a lot of ones that feel like that don't quite get there.
It's the non-action that's harder than the action, right? So I think another thing is that your investment style has to match your inner nature, and you have to be congruent with that and really understand yourself and where your strengths are and your personality type. And the EQ side of this whole game has to be at one. And sometimes, if we don't match our sort of with ourselves with the external energies, then you're just going to be forcing it. And I think it's a good exercise for all of us really to ask, where in my life am I rowing against the current, where if I was to think of it instead of putting up the sail and going with the flow, it would be so much easier. So that wraps up a little bit of Wu Wei.
I like it. I totally agree. The tailwind. I agree with both tailwinds. I also agree with I think one of the biggest mistakes you can make as an investor is investing in such a way that does not fit your psychology and your personality. It just opens up so many opportunities for mistakes. If you're doing something that makes sense to you and you can stick with it, if you know it to be right, or even more importantly, if you can keep your head on a swivel and change when change is coming. I mean, having an investment style that fits your personality, I strongly believe in. I always get weirded out when when I see people on Twitter say like, well, this is the strategy and then everybody else should just passively invest. It's like, well, that's the strategy for you and you should definitely do it. And other people, passive might be exactly what they should do. But the truth is there's a lot of ways to go about this business. And I'm not sure, it was The Psychology of Money, that book where it's a good book, everybody should read it. The whole discussion about that two people can look at a situation and come to wildly different investment conclusions and both be right depending on how they approach it, right? So like, I'm looking at this for 30 days, and I think the same store sales comp is going to be terrible, so I'm fading it, and then another guy looks at it, it's like, dude, I want to own this for 10 years, I don't even care. And the truth is maybe you're both right, and so the psychology thing. Sorry, getting off on weird tangents.
It's Morgan Housel's book too.
Yeah,
just shout out to Morgan there.
Yeah, Morgan did a good job.
Hey, Morgan. Yeah, the timelines can make a huge difference you can both be right, but over different timelines.
Yeah, duration matters. And just knowing that about yourself, that like, if I had lunch with a guy who's had some really good returns and he's a young guy and his entire strategy is he's like, I'm a macro guy. I really don't know what most of my businesses do. And so he was like, at lunch, he was trying to figure out what I was like, well, what does that do?
Zoom's breaking up.
Yeah,
you're breaking. But his point was, he was like, look, I just try to find these factor bets, and then I have these really short stop losses. And he's like, my returns are great. They're very tax efficient, but they're very good. And I'm like, dude, that is awesome. And he's actually very self-aware. He's like, this isn't going to last forever, but right now it's just been great the last 3 years. I'm like, good for you. And he's very self-aware. And I was like, that would not work for me. But I think for him, it's obviously working. And I'm just like, dude, more power to you. That's awesome. Go about it any way that makes sense.
The challenge for me has been something like value, which, if you talk to enough value guys, they'll all say value's evergreen. The idea of buying something for less than it's worth, how can that not work? But clearly there are different definitions of value. I mean, all of the software as a service tech guys would also say, look, we're doing DCF, doing fundamental analysis, looking at a long way into the future, which is what you should do. When I discount back those very high growth rates, I come up with a very big number. We're trading at a much smaller number than that very big number. And so not a lot has to go right for me to get really great returns. And then maybe Jake and I would look at that and say, well, those growth rates have base rates that are not supportable for that period of time. And the rejoinder would be, well, we're in a brand new world. It's a networked world. And those are all very good arguments. And I honestly don't know what the correct answer to that is. I don't know which side of the fence I want to be on. I've kind of made my bet and I'm confident in my bet, but equally, I can sit on my own shoulder and see there are plenty of other arguments the other way.
No, that's
I agree. That's a
rational.
great assessment of where we find ourselves.
Yeah, that's right. But it works for you. The key is it works for you. You understand it. You know what you're doing. You know the bet you're making. You're intelligent. You're a big boy. Like, if it works, and my belief is that it will, we'll see if I'm right about that. But if it works, it's like, great. And if it doesn't, it's like, well, that was how you went about it. And you made your choice, and you did it intelligently and rationally, and it might work and it might not. But
the only problem is I felt the same way in 2010, and I also felt the same way in 2015, and I was wrong on both of those occasions. I think Jake and I have diagnosed the 2015 problem, but we'll see. If it comes around again, we'll let everybody know. 3 questions and dudes.
Is the diagnosis even a blind squirrel? Does it start even a blind squirrel finds a nut? Is that the?
I think that.
Well, no, that
I
was
think
2008.
The spread is the big Well, that was I think the spread is the big issue for is a big driver of returns to value. When the very best companies are trading as if they're the junkie companies, then you are paid to be buying those very best companies. And when the spread gets very wide, then it's still a handicapper type market. You want to be on the things that I think the reason that a lot of the companies worked really well from 2015 to date is they just got the good stuff got way too cheap, and you were basically taking a free hit on whatever happened. And then that has happened. And you can look at now that the multiples are very different to where they were in 2015. Microsoft is a great example, went from like an 11% free cash flow yield to like wherever it is now, 3%.
It was hated. It was amazing. The narrative has changed on that one. It's almost like you're suggesting that price matters, and I'm not sure I agree with that, Toby.
There's been no evidence that that's the case. There's been no evidence that's the case for the last 3 years.
I'm going to need to see some data that price matters from you, Toby, before I agree.
JT, what are you doing in St. Louis? You tell everybody what you're in St. Louis for.
That's none of their business. No, I'm here for an investor conference that should be pretty good. It's a lot of smart people showing up. So it should be fun. I'm excited it starts today. So I don't even know exactly what we're doing, but it's going to be good.
I got a question here. When's the next crash? I've predicted about 15 of the last 2, so I'm prepared to have a swing at it. I don't know, honestly, but I do think it's funny that, for all of the ARKK style companies, like I just put that, it doesn't necessarily have to be in the portfolio, but a lot of them seem to top out in February this year. And it's been a much better run for the kind of junk, the little turd balls that I prefer since then. And so I think sometimes like the crashes seem to be they take about 8 to 12 months from the peak. You just sort of bump sideways and then you really see some fireworks. So if I had to like have a guess, I'd say Q2 next year with a straight face.
Bold.
You think so? That's a big statement. Yeah, I was going to say it's take. The only thing I know for sure to answer that question is it's definitely coming. That's the one answer I have.
We have reached a new permanent high plateau.
There you go. Inducing it, calling down the thunder. I have no idea, by the way.
16% compound returns for the next 10 years. Everybody wait for it.
It's not at all predictable. I'm just speculating for fun, not for profit.
Too hard.
Yeah, I think so.
So hard.
Could a difference in the price increases of goods we import versus goods we mostly produce shed some light on whether inflation is more driven by supply or demand? Wouldn't you have some equilibrium? The stuff that like the locals can charge more for it now, can't they?
So I'm going to have to read that. I don't have the questions open. So what was the
could a difference in the price increases of goods we import, so imports versus things that we make at home, shed some light on whether inflation is driven by that supply and demand?
Well, there's so much that we don't make at home. I mean, that's the problem. I mean, a lot of it we have to import, right? So I think,
or a component of it.
Yeah, or a component of it to complete the finished good. So I do think that the domestically produced goods have a reasonable shot of having a different path than imports. But the problem we have in the United States right now is that we just don't have labor. I mean, that's and one of the things I'm kind of worried. Where my head is now is I'm kind of worried about rolling labor issues, meaning so you could
a lot more unionization talk right now.
No, I don't mean unionization may come back in force, but right now labor has such power, so much negotiating power that I'd be shocked if unions became more of a force. I mean, that's usually when you don't have the power at labor where unions become the issue. But right now, you can if you're an able-bodied, U.S. citizen, you want to go get a job, like there's plenty of jobs for you, and everybody's talking. So I'm worried that like everybody right now is, doing X, and that they go, and I'm talking about just normal trades. I'm not talking about really skilled labor, that it just shifts from one job to the next job, and that just creates these, as wages start to rise in one area, you get these shifts, and then you sort of have it down, and
it equilibrates over time, though. Surely, sort of finds its level.
You'd like to think, we certainly have enough bodies, right? So you'd like to think that we have enough population. So you'd like to think that that people will go back to work, and all of this will sort of normalize, which kind of feeds into that like deflation of goods and services prices in 2022, assuming they all go back to work, and you don't have to pay the higher wages because we do have plenty of labor. But there's no guarantee that will happen, but very well might.
Folks, we've come up on time.
I didn't answer the question. I think
you killed it. I think you did a great job. Hey, thanks so much for joining us this week, Mike. Love having you here.
Yeah, thanks,
Man,
Mike.
I appreciate it. I appreciate it, guys.
I always learn something, which I like.
Hopefully it's useful. But yeah, dude, I enjoyed it. I love this guy. So anytime you guys need, just let me know.
Thanks, folks.